Welcome back. Before we take a look at the day's business news, let's take a look at the stock indices across the GCC. And in our top business story, according to a new report, Dubai's successful bid to host the World Expo 2020 is set to add an estimated 4.5 percentage points to GDP growth in the UAE, amid forecasts an extra $10 billion of private sector cash will be injected into the GCC. However, the report by Qatar National Bank also warned of potential risks of overheating the market and increases in debt as a result of holding big events such as the Expo and FIFA World Cup in Qatar in 2022 in such a small period of time. A report from HSBC estimated the event would attract $10 billion of private sector spending to cover all the costs of putting on the event, positively impacting consumption and investment growth and the jobs market. QNB Group said these factors should add an average 0.5 percentage points GDP growth annually in the run-up to 2020 and an additional 1 percentage point in 2020 itself as an influx of people into the country boosted domestic demand. The Qatar lender also said that Dubai hoped to reap long-term benefits from the Expo 2020 by leveraging the event as a catalyst for economic transformation, stating that the hosting location at Dubai World Central, which is close to the new Al Maktoum International Airport and Jebel Ali Port, could become a strategic location for business and trade, leading to the creation of permanent jobs and communities and a new era of growth for the UAE based on the development of human talents. Occupancy in Abu Dhabi's hotels and hotel apartments climbed 10% to 83% in November over the same period in 2012, bringing the total number of arrivals to date to over 2.5 million. The figures were released by the Abu Dhabi Tourism and Culture Authority in a statement on Sunday. According to the tourism body, guest arrivals at the Emirates' 149 hotels and hotel apartments jumped 26% to around 260,810 in November compared to the same period in 2012, resulting in a 19% jump in revenue to 669 million dirhams. Guest nights were up 27% to 856,785. In the first 9 months of the year, Abu Dhabi attracted around 2,530,810 guests, up 17% compared to the corresponding period last year, according to Abu Dhabi TCA. Year-to-date occupancy rate stood at 70%, up 9% over 2012, while average room rate reached 477 dirhams 22, declining 1% in the same period. Total hotel revenue, meanwhile, stood at around 5 billion dirhams, clocking 11% growth over 2012, according to TCA Abu Dhabi statistics. Also, food and beverage income rose 19% to around 1.9 billion dirhams. India, the UK and Germany continue to be the top overseas source markets for Abu Dhabi. Markets traded sideways amidst the thick of the holiday period, and US equity markets continued to march to new record all-time highs, with the Dow Jones closing at 16,478. With the FOMC decision now fully priced into markets, risk appetite has picked up amidst growing confidence in the US recovery. The US dollar index, which tracks the value of the US dollar against a basket of major currencies, slid to an 8-week low before closing the week at 80.40 levels. The euro, British pound and Indian rupee all continued to build on their gains against the US dollar, with only gold continuing to trade lower against the greenback. To talk more about this week and the week ahead, we spoke to Gaurav Kashyap, the head of futures at Al Pari Middle East.
Well, we saw a week last week filled with very thin trading conditions. Of course, volumes have dramatically dipped following the FOMC announcement in mid-December. We expect more of the same through the first week and the second week of January, with investors remaining on the sidelines. Once again, we saw the Dow Jones and US equity markets as on a whole march to record all-time highs in trading last week. Of course, this is on the back of improved optimism, improved sentiment, and of course the Santa Claus rally, which has taken markets higher. We can expect equities to continue building small gains in the first 1 or 2 weeks of January. And we can expect the US dollar to remain on the back foot. Once again, following that FOMC decision in mid-December, we've seen risk appetites increasing, with confidence also on the rise. There's been growing speculation that the US recovery is well and truly on track, and this was of course highlighted by the cut to the Fed taper in December. So overall, we can expect the US dollar to remain on the back foot amidst very thin trading conditions in the week ahead. We can expect the euro to trade between 137 and 139 against the US dollar in the week ahead. The British pound looks good to consolidate between 164 and 166 against the US dollar. And gold, of course, is expected to remain anemic against the US dollar, with a move towards 1180 still on the cards, a resistance coming at 1220. We have a very thin trading economic calendar in the week ahead. Other than consumer confidence, we will be looking at the US ISM for manufacturing, expected to come in at above 56. Of course, this is in the lead up to next week's US non-farm payroll report, which once again, if it does come above 200,000, we will see the confidence continue to build with higher equity markets and a weaker US dollar across the board.